Hi, in this brief video, I will introduce you to the discontinued operations process, how we present results of operations when there are discontinued operations. A decision has been made to discontinue one of the segments of the company. We will also demonstrate earnings per share in this brief video and discuss what that is at a very simple level. We will then, in a follow-up video, illustrate discontinued operations and earnings per share. Okay, so discontinued operations. If a company is going to sell or dispose of an aspect of their business, the results of that part of the business are going to be broken out and reported separately as an income or loss from discontinued operations section at the bottom of the income statement. This treatment ensures that investors have the full earnings picture for that period, but also have information about the profitability of the continuing business, so they're able to predict future earnings based on what will be there in upcoming years. Certainly, the results of operations for the business about to be discontinued are relevant, but they're less relevant for predicting future income statements, which is one big aspect of what investors are doing when they analyze our income statement. Income from discontinued operations are reported beneath income from continuing operations as another section, and they are reported net of the tax impact of the profit or loss from this division that's going to be discontinued, or this segment that's going to be discontinued, this business segment. This is done for all the years presented, which is usually the current year and the previous 2 years in the case of the income statement. Okay, and we will see an illustration of that upcoming. Now go a few pages forward in your notes and you'll see the earnings per share discussion in general. Earnings per share is also presented on the income statement. Net income is reported in dollars. It represents the total profits that the company has generated for shareholders, even after income tax. Investors will also want to know that profit earned for each shareholder. We want earnings per share from continuing operations and earnings per share for the discontinued operations as well, when there are discontinued operations. We're going to show the investors and the users of the financial statements two earnings per share measures: basic earnings per share and diluted earnings per share. You will see how diluted earnings per share is calculated in a very sophisticated manner in an upcoming course in the financial reporting series. By the way, diluted earnings per share is the earnings in the price to earnings ratio. You might be wondering, what's the price to earnings ratio? The price to earnings ratio is very important. It's a very widely used metric. And it shows the price as a multiple of the most recent 12 months earnings per share, and specifically diluted earnings per share. What that allows us to do is compare across companies. We can say, well, Walmart is trading at 13 times last year's diluted earnings per share, and the stock price of Target is 12 times the diluted earnings per share for the last 12 months. So it reports stock price for the company, the price per share of any company, as a multiple of the earnings per share for the company, and allows for comparative purposes which one is trading relatively more expensive based on the per share measure. Price to earnings ratio is the most widely used metric in the investment world. Again, it shows what is the price of this company's stock, not just the nominal price, which is always useful and meaningful, but also as a multiple of each dollar of net income, which makes it comparable to other companies where you look at their P/E ratio and see what they're trading at as a multiple of each dollar of net income. Here's the specific calculation. Basic earnings per share is net income available to common shareholders. I'll talk about that in a second, divided by the weighted average common shares outstanding. I'll talk about that as well. Net income available to common shareholders is the net income from the income statement, but less any dividends paid on preferred stock shares. We take these out because these are amounts paid to the preferred. We are providing the net income available to the common shareholders, the shareholders of our common shares. Well, if we have dividends payable to preferred shareholders, they are going to get their dollars before common gets any. So if we want net income available to common shareholders, it's net income minus any dividends we need to pay to the preferred shareholders. This begs a quick sidebar here. You're going to learn a lot more if you're not familiar with the terms common shares and preferred shares. They're fundamentally different. The biggest aspect of equity, most income, most capital is raised by issuing common shares. But there is also sometimes at companies, especially big companies, another class of shares called preferred shares. And they're preferred, it begs the question, preferred as to what? They're preferred as to dividends. And the reason they're called preferred shares is when dividends are paid, the preferred shareholders get the dividends before any common shareholders. That's why we break it out here. You're going to learn a lot more about that in finance courses and in accounting courses. So just keep that in mind. We also provide something called diluted earnings per share. This number incorporates the dilutive effect of all potential common shares. What do we mean by potential common shares? These are stock contracts, such as options, warrants, and other contracts. Or maybe they're convertible securities, convertible bonds, convertible preferred stock. That means in the case of convertible bonds, they're currently bonds paying interest to bondholders. But those financial instruments, those bonds, have a contract in them that the holders of the bonds can convert them to common stock, common shares, based on some conversion metric. Convertible preferred stock, well, this is preferred stock right now, but it's convertible to common stock under some conditions at some point in time based on some metric. And then there are other things such as subscribed shares. In an upcoming financial accounting reporting course, you're going to see exactly how this is done in the real world. For now, just keep in mind that such things exist. Earnings per share calculations are introduced here, and then they're mastered in Chapter 19 of this textbook that we're currently using. And that topic will come up in another course, So the numerator of diluted earnings per share is that diluted earnings available to common shareholders. You'll see how that's calculated. The denominator in diluted earnings per share is the weighted average diluted number of shares of common stock outstanding during the year. It occurs to me right now that I didn't talk about diluted earnings per share, weighted average common shares outstanding in the case of basic. So weighted average common shares outstanding refers to is necessary because this number is going to change over the period often because of, for example, stock options being converted, stock warrants being converted. And by the way, this happens fairly common because a lot of managers have stock options. And so weighted average common shares is some weighted average measure of the shares over the whole period. Because remember, net income available to common shareholders is for a year or for some period of time. And so the denominator must represent the number of shares over that period of time, which might be changing. So for now, we'll assume that it changes fairly linearly over the year and use the beginning number plus the ending number of shares and divide that by 2. That's a 2-point average, which will tell us the weighted average common shares. In the real world, we can do this on a daily basis or on a monthly basis. We can do a more sophisticated calculation of weighted average common shares outstanding. We'll see an example of this in the illustration coming up. Okay, and that's an introduction to these concepts. Let's now turn our attention to a case. And it'll be a case familiar to you. I'll see you in the video. Thank you for your attention.